Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. This week on the podcast, I talk first to ffolkes Davis, who is chairman of the management company that looks after the running of Nippon Active Value, the Japanese activist trust, which has been one of the few unalloyed successes of the investment trust sector over the last couple of years. Not only growing in size through merging with two other trusts with a Japanese focus, but also having the distinction of being one of the few trusts that is currently trading at a premium. Only about a dozen out of the whole sector have that distinction at the moment. And after that, I shall be talking to Max King, the former fund manager at Investec, who is now well known as a commentator, a contributor to Money Week and other publications. Always a lively conversation, this one. We'll be talking about the state of the investment trust sector and the outlook for the markets from here. This week, as it happened, we had more evidence that the expected path of interest rates is somewhat more cloudy than it appeared to be at the start of the year, with the latest inflation figures in the US proving that inflation is being disappointingly sticky, and in turn suggesting that interest rate cuts are not as imminent over there as many hoped or thought. Although the European Central Bank was giving out more positive vibes this week, saying that it was not going to be stopped from cutting its rates in June just because the Federal Reserve may be holding their rates steady. Take-up of the latest Treasury issues in the US was muted, leaving yields there to rise, while in the gilts market prices also fell again, particularly at the longer end of the maturity spectrum. Gold and other precious metals put in another decent performance, though also weakening Friday, but both copper and oil consolidated rather than moved any higher. Nonetheless, it was another good week for the UK equity market, with some evidence that the economy may have recovered from the temporary technical recession it experienced in the second half of last year, according to the statisticians. Though what price that particular outcome will be revised away in a couple of years' time, as so often happens. With both the FTSE and the all-share index up around 1%, and the 250 and AIM indices also doing well. In fact, the UK equity market outperformed most other leading markets, with the S&P 500 falling 1.5% over the week after a particularly poor day yesterday, although the Japanese equity market was also slightly up. The Investment Trust Index, which consists of some 190 trusts that are in the all-share index, was down 0.4%, and the average discount remains disappointingly wide at around 16%, with many alternative asset trusts remaining out of favour against a background of firmer bond yields. Casting an eye down the list of winners and losers, the former outnumbering the latter by around 2-1, a sign that it was the largest, most liquid trust which experienced the worst performance this week. I counted 15 trusts which are showing double-digit gains for the week, led by Seraphim Space, this year's best performer year-to-date. And among the bigger names in that list also, Hypnosis Songs and BlackRock World Mining stood out, along with some smaller property and smaller company equity trust names. The list of losers was headed by Asian Energy Impact, formerly known as Thomas Lloyd Energy Impact, following the news that the board has bowed to the inevitable, and proposed a managed wind-down following the troubles at its largest renewable energy project in India, which culminated in the manager being dismissed and replaced by Octopus Energy. Although who knows how long it will take to be completed, this particular wind-down. Always one of the issues when you have an illiquid asset portfolio that needs to be sold at a time when perhaps there aren't as many buyers as there would be in better times. Renewables again stood out amongst those experiencing share price declines. The average yield in the renewable energy sector has now reached a striking 8.4%, according to the AIC statistics. There were fewer results out this week than in previous weeks, with just 5 trusts reporting their latest annual results, all of them on a positive note, posting positive NAV total returns. The best absolute numbers coming from the debt fund Marble Loan Financing, NAV total return plus 17.5%, and from Mercantile, the JP Morgan managed small and mid-cap trust, which beat its benchmark by 4%. The other three reporting were Impacts Environmental Markets, ticker IEM, Downing Renewables and Infrastructure, ticker DORE, and Global Opportunities Trust, all three posting small positive gains. Though in the case of Impacts Environmental Markets, its results trailed the two comparator indices it follows by a margin. Caledonia Investments, ticker CLDN, also issued a trading update showing a 7.4% NAV gain for the year to 31st of March. Full results there coming out in May. Amongst other news, there were updates on the Tritax Big Box and UK commercial property proposed merger, where the chairman of the latter, unusually, has declined to recommend the terms, although the other directors have done so, arguing that the board could have done more to investigate other solutions. And there were updates on the wind-downs proposed by Aberdeen Diversified Income and Growth, ticker ADIG, and VPC Specialty Lending Investments, ticker VSL. You can, as always, check out all these news items and results in greater detail as a subscriber to the Moneymakers Circle, where this week, alongside our other regular features, we have an in-depth profile of Chrysalis, ticker CHRY, the Growth Capital Fund, which has been on a rollercoaster ride since its IPO in 2018, hitting a high of 250p in 2021, before a savage derating saw its shares fall to a low of around 50p last year. It's now slowly recovering, with the shares up 8% this year, and the discount has narrowed to a mere 40%. Everything is relative in this game. When I had the opportunity this week to catch up with Paul Ffolkes Davis, who is chairman of the management company that looks after Nippon Active Value, the Japanese activist fund, my first question to him was, and I have to say this with all sincerity, that since we last spoke a year ago, things have gone pretty swimmingly for your trust. You've done a couple of deals, absorbed two other investment trusts, and you have the distinction of being one of only about a dozen trusts, which is, or has been trading very recently above par. So let's start with a congratulations and tell us how the year has been for you. You were very positive a year ago when we spoke, but things have gone well, have they not?
Well, thank you very much for the congratulations. Yes, I think things have gone pretty well according to plan. I mean, when we spoke a year ago, we hinted at our desire to make the fund bigger. We talked about the possibility of secondary offerings, and I suggested at the time that there might be the possibility of corporate actions. That was because we had already had an inkling that the first of the two investment trusts that we rolled over, to use the stock exchange's rather quaint and inaccurate phrase, was possibly in the making, and that came to pass, and so did another, and I'm sure we'll talk about those in a minute. So I think when last we spoke, the fund was about 170 million AUM and about 140 NAV, something like that. Today, assets under management are 337 million, and we're touching off and on 180 for the NAV. Today, it's about 178.5. And as you say, we have had a period of trading at a discount, never as great a discount, I'm happy to say, as some of the funds in the investment trust sector, but it is currently around NAV, maybe a slight premium today.
So you mentioned the rolling over of two other trusts, and they were Atlantis Japan Growth and Aberdeen Japan Fund as well. And they've sort of rolled over into you, implicitly accepting that you are the one with the growth potential and also the one with perhaps the best strategy. So how did they come to pass? Were you approached or did you go looking for them?
Yes, I should actually pay homage to the boards of both the trust, because they are the people who made the decision that, facing, as they both did, continuation votes, which they felt they were likely to lose because the funds had not been performing particularly well. And the first one we did was Aberdeen Japan Investment Trust, and then we did Atlantis Japan Growth. The way it worked was we were approached by Shore Capital, our broker, who coincidentally were also brokers to Aberdeen Japan Investment Trust. And they said, look, this isn't obvious because Aberdeen Japan Investment Trust is a long-only large-cap Japan investor. It's not an activist strategy. Doesn't look like you. But the board has asked us to put a beauty parade together of other funds that might be interested in combining with them. And if they can't find anything they like or they feel they can recommend to their shareholders, then they would roll it up or they would close it and return the money to shareholders. So we were, I think, one of 5 firms that pitched for this business. It is by any other name a takeover. And we were able, in the end, to convince the board to recommend us. And at the general meeting that followed, over 99%, I think, of those who voted in favour of combining with Nippon Active Value Fund. So that shows, I think, a lot of courage and imagination on the part of the board and similar amounts on the part of major shareholders and even retail. And one of the great things for us about this whole process is, I think you might remember last time we spoke, when we were trading at a discount, I said one of our problems has been that we've never had much of a retail following. We were mainly held by institutions. So these 2 acquisitions, and I'll talk about Atlantis in a moment, have corrected that to a large extent, and we are now widely held both institutionally and by retail. That, I think, has helped our liquidity and therefore how we trade. Having been accepted by Aberdeen Japan Investment Trust, we then approached Atlantis because we could see that they were in a similar situation. My colleague, Gifford Combs, knew the chairman of the Atlantis Fund. They were also trying to decide what they were going to do. We made a pitch for the business, and the board decided again to recommend combining with us, and a similar thing happened with the shareholders. So all of that took place last summer, and the combination of the 2 was completed, I think, in September. And we received a large amount of money. Atlantis was a long-only smaller cap fund. Both of these funds didn't really resemble us in any way. They were both of the order of 70, 80 million AUM, and they had about 70 or 80 stocks each. So not the way that we run things. So we had an issue when the 2 deals closed, which was more or less simultaneously. What were we going to do with the stocks that came across? It's called a rollover because you can't receive cash, you have to receive the funds or the actual counters which are rolled over into your account.
So there was a challenge to actually get rid of all those without losing too much money in the process, essentially, and you managed that very quickly, I think.
Yes, you're absolutely right. It is a question of get rid of all those. A lot of people have asked us, did we keep any of their existing stocks? And the answer to that was no. We worked out how long we thought it would take. We thought it would take about 6 weeks. It took a month, and we realized at the end of the day, £90 million. We obviously required a new prospectus to do these 2 transactions, and we took advantage of that to slightly vary the terms of our fund to allow us to, if we needed to, go up the market cap curve of the kinds of companies that we would invest in. We'd originally set ourselves a target of normally going for companies with up to $1 billion equivalent market cap. We increased that to 3. And we had originally set out to say that we would invest in around 20 stocks. And I think last time I spoke to you, it was 22. And we said, well, we might need to go up to around 35. As it happens, having done both those things in the immediate aftermath of the acquisitions, i.e. increased the number of stocks and gone slightly up the capitalization curve for some of the counters, so as to absorb the money that we took on board, which is over £90 million, we have now been able to revert more or less back to our preferred methodology of largely small cap companies. And I think we currently have 30 names in the portfolio, but 2 are being sold. So we would expect on average that the portfolio will now remain pretty concentrated around 25 to 30 names maybe, and mostly, not exclusively, but mostly small caps.
Would it be fair to say, I can't remember if I'm imagining this or not, but I seem to recall that when you came to the market, you were one of the last stocks to do an IPO before the window came down with the last 2 years of derating.
February 2020, you're quite right.
February 2020, yes, I remember those days very well. But at the time, I think you were a little disappointed. You hadn't raised quite as much money as you hoped. But actually, your kind of story is a bit of a vindication of the idea that even though everybody says you've got to be 500 million or $1 billion to be a success, you started with just over 100 million. And perhaps, events have helped you a little bit because of all the consolidation that's now going on because of the derating. So did you have your doubts about doing the IPO back in those happy days before derating began?
Well, you'd probably better ask that question of my colleagues, Jamie Rosemore and Gifford Combs, who did most of the marketing at the time back in February 20. If you remember, I think we talked about this a little bit, but the purpose of Nippon Active Value Fund was to do something slightly different to what those two had traditionally done in Dalton Investments, which is their US vehicle, has about $3 billion invested in Japan. But it has been largely and traditionally a friendly investor of owner-operator or entrepreneur-operator companies. They wanted to create something which was permanent capital because they knew that activism was likely to be controversial and people might ask for their money back at difficult times. So that's why they selected the route of the investment trust. And I know investment trusts have become something of a problem for the UK investment market over the last couple of years with interest rates rising and so many of them now trading at large discounts. But actually, it's worked out pretty well for us. We wanted to have a listed entity, permanent capital. We were aware that it was too small. I think I said to you last time that we wanted to grow it, that we were being told by the major funds that they might have a little bit of us, but unless we were 250, 300 million, we wouldn't qualify for their core investment funds. Well, we now do, and we are starting to see larger allocations from the sorts of people who've always liked us. Interestingly, at the moment, we're seeing selling from those sorts of US institutions who I would call discount arbitrageurs. So the fact that we're trading at a premium doesn't suit them. So there has been quite a lot of supply coming to the market in the last few months, and it's all being absorbed pretty happily. Otherwise, we'd be trading at a discount again. So I think that's going quite well, but we're not stopping here, and we would like, obviously, to continue to grow the fund. The bigger it gets, the more liquid it will be. We're not running out of targets, although the environment has changed quite a bit in the last year, pretty much in our favor, but that is also making companies more wary and more efficient than they used to be. So there is always the possibility that over time, this opportunity will start to diminish because companies will have reached fairer values. But we're a long way away from that happening, particularly in the smaller companies sector in Japan, which has not benefited in the same way as the general move upwards in Japanese index over the last year, which has been very considerable. It's probably the best performing mature market in the world over the last year.
Indeed it is. So before we go on and talk about the changes that have happened in the Japanese market, which, as you say, work in your favour on the whole, have you run out of potential partners in the listed investment trust space in the UK? In other words, you've done a couple of deals with smaller trusts.
Well, let's put it this way. There's one other firm that looks like us, and I think most people would like to see, in the true sense of McDonald's and Burger King on the same corner, people like to think that there is somebody else out there who will keep us honest and we will keep them honest. So I suspect that they are not available for acquisition. If they were, we'd be delighted to talk to them. The alternatives are much larger funds like the JP Morgan Fund or the Bailey Gifford funds, and I just don't see them volunteering to go into a process whereby we acquire them. So there doesn't seem to be a lot of alternatives out there for us to acquire. Although, as I say, we'd always be happy to talk to anybody who did want to talk. I
think the one you're referring to there is AVI Japan Opportunity Trust.
It might very well be. Yeah.
It might very well be that one, which has a market cap of around 185 million, something like that. Well, let's move on then and talk about what you do. You've very successfully managed to take on that extra money and then redirect it back into the strategy that you are pursuing rather than holding on to the stocks that they once held. And your strategy is about engagement with company managements and persuading them, I think, rather than threatening them, to change their ways a little bit and to become more efficient and more shareholder friendly, a process which has been, I think, greatly helped by the recent developments by the Tokyo Stock Exchange and by the Japanese government and regulators and so on. Perhaps you could describe the changes that have all come in quite a rush in the last 12 months or 2 years, maybe.
Yeah, well, if you ask me to say who is the greatest Japanese activist, I wouldn't point at myself or even at our friends at Elliott or Oasis or any of the other big funds, or even at Mr. Murakami, who of course is infamous for being very effective at this. I would point at Mr. Yamaji, or the head of the Japanese Stock Exchange, because it is him who's really conducted what is a very clear campaign to try and improve the valuations of Japanese companies. And the thing that he initially attacked in April a year ago was companies trading at below book, and we had a short discussion about that when we last spoke. And at the time, there were over 50% of companies who were trading below book value. I actually don't know what the current number is because he has started publishing his famous list. And in a very Japanese way, rather than publish a list of companies that are not telling him how they're going to improve their valuation and their stock price, he's publishing the list of the ones who are telling him. So by a process of deduction, we are able to work out who is still on the naughty step. But increasingly, companies are coming up with master plans to do this. Whether or not they necessarily institute what they say they're going to do is to be seen. And Mr. Yamaji has his eyes open for that and has made that point. So it's all good. The latest thing that he's instituting is that by April 25, he's requiring all Japanese companies that are listed to produce financial data and reports in English as well as Japanese. So the thing is becoming more transparent, and this is both good from our point of view because obviously companies are easier to nudge in the right direction when they're under pressure from their own regulators, but it also accelerates the process whereby the cheapness can, over time, start to go out of the market.
But for the moment, there's still lots of opportunities out there.
Oh, there's still hundreds of opportunities, and we still have very many stocks in our hopper. We've had, in the last year, success with two that we spoke about last year that were causing us some trouble. I don't remember if you recall Intage Holdings, which was a company that steadfastly refused to treat with us, and in the end, I think became so fed up with us that they persuaded NTT Docomo, a partly government-owned business that has actually no synergies with it whatsoever, to buy just over 50% of it so that the president or the CEO of Intage could maintain his story that he felt that a listing was very important to give credibility to his business. So that one had a happy ending, although not the ending that we had envisaged. We didn't sell into the tender offer because we thought that minority investors would be disadvantaged and the share price would go back down after the tender was over. We just sold into the market. We sold our entire holding, did very well. Thank you very much. Although we do think that the transaction was a bit of a nonsense. And, those people who still hold Intage, not sure why they think that the stock will ever perform now.
That sounds more like old Japan than new Japan to me, I must say.
Yes, I think it is a case of old Japan. So you could say that right to the end it was a failure. The success was that we made over 100% on it and we got out because we were talking about our being a stockholder last time we were here. So we're not, and there was a financially happy resolution, although I don't think from a governance point of view it was very satisfactory. We also spoke last time about a stock called T&K Toko, which is an ink and resin maker, where we had launched a tender offer and that had failed, but that had stimulated the management into talking to us on a more intense basis. I'm happy to say that what came out of that was they threw themselves eventually into the arms of a white knight, Bain & Co. Why anybody would actually think that Bain & Co. was nicer and likely to be softer on them than the Nippon Active Value Fund, I'm not sure, but they did. And that company was tendered for by Bain. They have got the company in its entirety. The tender, I think, will close at the end of this month. We tendered our shares into it. And I'm happy to say that on this occasion, something else that we'd failed to do a year ago, which was to get a bit of what I would call the back end, i.e. of the private company. We are currently negotiating with Bain to have 15% of the private company across Nippon Active Value Fund and its co-investors, which is, if you like, the concert party of Nippon Active Value Fund and various Dalton funds, who are also investors in T&K Toko. In fact, they've been in T&K Toko for 13 years. So it's a stock that part of our group, if you like, has owned for a very long time. The exit was nice. I'm hoping that the second liquidity event, when the company's either relisted or sold, will be even better.
So have you gone into the leverage buyout business suddenly? Or
Well, you asked me about a year ago about leverage buying out as a methodology for MBOs. And I said at the time, it makes perfect sense in Japan because the banks lend money so cheaply. And I don't think any of that's really changed. So Bain, I think, is in the leverage buyout business, and we're just tagging along for a little bit, thanks to their open-mindedness, because they did realize that we had started the process and that we can be useful. I think they're hoping that by being nice to us on this one, we will lead them into other opportunities.
Right, okay. Coming back to what you've achieved so far, you've had some good returns. You say the share price is now just under 180p, and you started at 100p, so you've had a good run in the 4 years you've been going. How much of that has come from kind of fundamental value, and how much of it, in very broad terms, do you think has come from prodding the companies into doing things differently? If I can make that distinction.
I should know that, and I don't. I mean, I don't even know how much of it has come from the fact that the markets have improved generally anyway, although I think small companies have not benefited in the same way that the larger ones have in terms of all ships rising. What I do know is that most of our performance is down to those companies where we've had the closest engagement with the companies and where that engagement has led to either an MBO or the company being re-rated by virtue of allocating capital better. If we look at our attribution slides, our top 10 stocks have accounted for most of the performance.
Right. So the one thing you haven't been able to see amidst all these other successes is you haven't managed to persuade the yen to recover in value. Admittedly, it's not your job to do that, but the market has not done that for you, let's put it that way.
Well, again, a year ago, we were 40% up in sterling and 75% or so in yen. We're now 80% up in sterling and 145% up in yen. And if it can be believed, the ending of the interest rate control policy has resulted in a weaker, not a stronger yen. And we are really still waiting for Mr. Ueda to do something about this, because the yen hit a new low against the dollar today. So it's all pretty extraordinary.
I guess it's got something to do with the fact that American interest rates are still so much higher than they are in Japan. But at some point, the fact that the Japanese central bank has sort of changed its tune and is looking for a new regime, shall we say, it may just take time to happen.
I'm not sure it's changed its tune, actually. I mean, if you want to continue the musical analogy, I think it's changed the key that it's playing the same tune in, so that no longer are they insisting on negative rates, but they're not going to allow rates to rise beyond 0.5% or so. So until they feel sufficiently confident to allow the yen to start to rise to a natural level, I think the yen can remain weak. What they probably will prefer to do is to defend the yen at moments when, like now, it is particularly weak. I find it extraordinary. I'm amazed the Americans are still willing to put up with this, but they do need an ally in Southeast Asia. Can't imagine anybody else being allowed to get away with running their currency as weak as the yen has been for so long. But, they must be wary of Toyota and Sony and those companies that are bringing home the bacon and benefiting from a very weak currency. So getting the balancing act right is a very tricky thing for the Bank of Japan. One day will look good.
Of course, in due course it will. But you don't do any currency hedging. You always said you're not going to.
We don't do any currency hedging. We've always said we're not FX traders. This is a yen investment. You're just paying for it in sterling, and sooner or later you will get your just reward.
And you don't use gearing as well, or at least not at the trust level anyway. You might get involved in a buyout where you might apply some gearing, but there's the trust level. You're still not going to use gearing at any stage. Is that right?
We do have arrangements for gearing, yes. We have a facility from our custodian, Northern Trust. What we've always said about gearing is we will use it to pursue specific situations. So both Aberdeen and Atlantis funds, when we took them over, ran their stock slightly geared all the time. That's not going to be us and was never the idea. But when we need particular firepower for a particular situation, we have up to 20% of the fund available to us through loans from Northern Trust. And we're always talking to the Japanese banks as well about whether they will help fund an MBO or any other corporate action. Increasingly, this has always been a negative area. It's becoming a grey area. So what they're saying these days is, if we have no relationship with the company, then we might consider funding you. So I won't say that we will never gear the portfolio. We just won't run it on a geared basis. We will do something specific, and then when that's concluded, we will return the money and do it again on another occasion.
So if we then just turn, as we come towards the end of this conversation, towards what might happen this year in terms of opportunities and possibly realizations, you've got your 30-odd stocks at the moment. So how do you see the prospects for the year ahead?
I'd like to say I don't see it very differently from the last 3 or 4 years. As ever, we are having tussles with particularly 2 stocks at the moment. One is a leftover from the period after the three funds were consolidated. It's a slightly larger company than we would normally engage with, but we're having the mother of all fights with them, and we'll see how this turns out. The stock price is moving in the right direction at least, but we think that this company is ludicrously cheap and something has to happen. We'll see. And there is another company where we own really quite a large percentage of the company, which is a company that Dalton have owned for many years, NAVF's owned for over a year, where the father who founded the company retired, and we don't think his offspring are as talented, and we are trying to persuade them to take a different course. So these are the kinds of conversations we have all the time. There are 3 or 4 other engagements coming, and we will continue to strip out stocks where either we don't think we're going to have much luck, or we think that we may have miscalculated at the beginning. I can give you an example of a company like that. I went to Tokyo in February with Jamie. We saw quite a few portfolio companies, one of which was a company called Tech, which makes bridges. Perfectly good company, but there are 3 other companies that also make bridges, and it makes bridges for the state, and the 3 other companies all make bridges for the state. And we just came out of the meeting fantastically indifferent. So as we left, we looked at each other and said, let's sell that one. So we sold it. I can't remember whether we made or lost money. It won't be very much either way.
I like that. That's a nice way to describe it. Fantastically indifferent. If you're looking at your trust from the outside or as a shareholder, is the biggest risk that you might take a large position or a relatively large position in one of these companies and you do end up sort of in the trenches and you can't get out as satisfactorily as you did with Intage or things like that? Is that a serious risk?
I guess it is, yes. But I would say that the worst example of that I could think of was Intage. We were in that for 3.5 years. It finally unwound in September last year. And in the end, it went the right way. Increasingly, we've decided that we need to have larger percentages of companies than we were able to get at the beginning when we had less funds. So now almost the starting position is 5%, but we will buy 10, 15, or indeed up to 25% or more of a company if we think that that's what we need. There is a company at the moment where we've just agreed to go to 30%, but there is a special situation going on there where we're trying to prevent somebody else's TOB, and that might have helpful effects on our P&L in the short term. So that's unusual. We wouldn't normally buy that much of a company, but we will buy larger percentages than when we first started.
To round this up then, finally, you're going to stick to what you're doing, and you're going to hope to do as well as you've done so far, possibly even better. Who knows?
Well, we always hope to do better. Yeah, we're going to stick to our knitting. If we continue to trade at a premium, we would like to think about issuing more stock. It's really a question in these markets of a large investor coming to us and saying, we'd like a position of this size, will you issue stock to us? That hasn't happened yet, but there are 1 or 2 situations where I think that could. If somebody did do that, then we might do it on the back of a secondary offering later in the year. But as far as we're concerned, it's all to play for. Nothing has gone horribly wrong yet. Fingers crossed, which your listeners can't see.
I can see your fingers crossed, indeed. Very good. So, look, thank you. That was Paul Ffolkes Davis, who is chairman of Rising Sun, the investment managers to the Nippon Active Value Fund, ticker NAVF. So, my first question to Max King when we caught up this week was to ask him what his mood was like. Now we finished the first quarter of the year, I guess you can make a case for being positive or you can make a case for being negative. It depends really how you're inclined temperamentally. Where do you sit on the scale of feel good versus feel bad, Max?
I've generally been on the optimistic camp, so I've been generally bullish. But I have to say that the US market, now on a bit over 20 times current year's earnings, is looking a little bit up with events, particularly since I'm sort of concerned that there is upside in bond yields, which could knock the market back. So I'm happy to buy the market, but, I'd rather buy it at this price in 6 months' time, or buy it now and be prepared to be bored with inaction for 6 months. Maybe even lose a bit of money in the short term. I think you should always expect to be down in the short term on a new investment and be pleasantly surprised if you're not.
So you think that the prevailing narrative, if you like, depends who you speak to, of course, but the prevailing narrative has shifted from one about we've got lots of interest rate cuts coming this year, which always looked ambitious to me, to now some people saying, and perhaps you're hinting the same, that maybe actually we're going to see bond yields far from going down, they might actually go up a little bit. And inflation,
presumably, we need time for the earnings to come through. And I think there is a case for interest rate cuts in the UK, but not really in the States, because inflation is not coming down to 2%. It looks like it's hovering nearer 3%. Investment demand is strong because there's a lot of investment to improve productivity, and there's full employment in the US as well as in the UK. So this is not a time when the central banks want to be reducing interest rates, I don't think. Maybe a little bit of touch here, that touch there. And because the UK economy is in such dire straits, I suspect it's easier in the UK than it is in the US. But I don't think we should be hanging our hat on interest rate cuts. And I don't think that bond yields have got room to come down.
Right, so that might imply to me, or might imply to others, that you think basically the whole era of zero interest rates and so on is coming to an end?
I think it's come to an end, and that I think we must look forward to a period in which real interest rates are 1% and real bond yields are 2%. And if you take an inflation rate in the US of 2.5% to 3%, that suggests certainly 4.5%, maybe 5% on the 10-year bond. Maybe a bit lower in the UK, because I suspect that the long-term stagnation in the UK will keep inflation a bit lower. So maybe you can justify the current 4% in the UK, but it doesn't give much upside for a re-rating of markets. Although I think there's persistent good news coming through on earnings. And give it time, those earnings will come through and turn markets from being, in the US, a little bit expensive to being really quite reasonable value. And I think the same is true for other markets. I think the trouble with the UK market is the sort of the relentless pressure on markets from the establishment, from government, from the civil service, from the media and everywhere else. So it's sort of, to buy shares in the UK is like buying shares in Russia 3 years ago.
Okay, that's quite a statement. Before we go on and talk about the investment trust sector, which of course is our main focus, just tell me, what do you think about the strength of gold though in this context? If you're seeing rising real yields, you'd think gold wouldn't be doing quite as well as it is doing. So what's going on there?
No, I don't really understand it, but I long gave up trying to understand what's going on in the gold price. There's always somebody who's smart enough to be able to explain why it's gone up or why it's gone down, but it's very, very hard to rationalize. And it doesn't seem to me that gold is particularly expensive. And I think this might be quite a good time to sell your gold if you've got any, rather than to buy it.
Back in the day when you were managing clients' money or managing funds for Investec, did you always have gold in your portfolios?
Not often gold, sometimes gold mining, but gold mining has been disappointing for a long, long time. And the reason for that is that as gold mines dig deeper and further, the costs go up. The ore per ton of earth mined, the ore content goes down, the costs go up, and there isn't a correlation between the gold price and the profitability of mines. And you tend to find even when the gold price does go up and they become more profitable, then the government comes in and takes it away. So I don't think gold mining is a particularly attractive business either.
So let's talk then about the investment trust sector, which is both our main interest in a way, I guess one could say. So what do you think about the investment trust sector so far this quarter? Obviously, with rising yields, we've seen many of the alternatives struggling, but also discounts haven't come in that far from where we were last year. It's been mildly disappointing this quarter, wouldn't you say?
Yes, I'd say it has been disappointing. It's been generally positive and it's moving in the right direction, but not nearly as fast as one would have expected. And the alternatives have made slow but erratic progress. And the same is true for the rest of the market. Individually, you're finding some investment trusts which have done very well. 3i is now trading at a big premium to net asset value, and HG Trust is almost back to asset value, but there are a lot of them languishing at the back of the field. I suppose the American trusts are doing quite well. The technology trusts are doing quite well. Even Pershing Square, which I thought was an absolute no-brainer a couple of months ago, that discount has come down from 40% to 25%. So there's lots of good news around, but it's sort of not fast enough for the optimists, I suggest.
And how big an issue is it, as far as you're concerned, this whole debate about cost disclosure and about some of the other constraints that there are on any company that's listed in the UK, not just the investment trust, but more generally? It's kind of ironic after such a long period of Tory government, which you think would be kind of broadly sympathetic to capital markets and so on, that everybody is very gloomy about the state of the UK equity market and the fact that our companies are being brought up on the cheap and valuations are very low and so on. What's your take on all of that?
Well, I think it's not just cost disclosures, it's more general. It's regulation, which has been relentlessly against the investment trust sector and against all listed companies for not just years, for decades. It's taxation, the reduction of allowances for capital gains tax, the abolition of the investment income allowance, the freezing of IHT thresholds, the stamp duty, a relentless campaign against investment in equities. and also a general indifference by the political class and the media to the whole principle of savings and investment. The attitude is that savings and investment is only something that rich people do. And so they're just not interested. And I know that there's been some valiant attempts, and really valiant attempts, for example, by Baroness Altman to get legislation through. And there are sort of suggestions by the Chancellor that maybe they'll do something about it. But the way I see it is I think the regulator is dead opposed to any sorts of change. And I think they will do their absolute utmost to frustrate anything that either the industry, the government, or the Treasury suggests. I think over their dead body will they relent. I think the trouble with the regulator, I think the FCA is the green-eyed monster that scorns the flesh it feeds off. And I think that the FCA has long ago ceased to be a protector of investors. And I think it's become just a massive bureaucracy which actually stands in the way of investors, imposes costs, and sabotages investment and savings in the UK. I think that Britain would be a better place if the FCA was just abolished. I don't think it serves any positive purpose whatsoever. The great advantage is that I can say that, as you can, because we're not FCA registered anymore. But, those people in the industry, they're too scared of the FCA's clamping down on them. So it's like the sort of Gestapo coming from the dead of night to criticize them at all. And whenever you see these FCA officials, the supercilious condescension which they regard investments is appalling.
How do you explain that? That's a cultural thing, really, or is it? How do you explain how we got ourselves in this situation where, as you say, in certain respects, we are deliberately kind of anti-saving and investment when we're crying out for the fruits of that saving and investment for whatever reason? Well,
I think those who are interested in investment and see the benefits of investment will get into the business. And those who hate investment and the whole principle of investment and capitalism will seek to destroy it. And the best way to destroy it is to go and work in a regulator.
So when you're thinking about how the investment trust sector might perform over the coming months and years, are you kind of mentally factoring in some improvement in the regulatory environment, or do you think that it's a lost cause? There does seem to be some noises coming out, at least.
I'm not counting on it. I think there are some positive noises, but I think there's a very strong chance they'll be frustrated by the opposition of the FCA and the regulators. And I think that the politicians are thinking about doing the absolute minimum they can get away with. A simple policy is not going to change things like getting rid of stamp duty. It's going to be a whole raft of proposals and attitudes which are positive to savings and investments for the long term. Not something which is positive this year and then gets cancelled next year, or where there's always a sting in the tail and the government announces something which sounds positive, and then you find that there are three hidden countervailing negatives.
Yes, and it does take a long time for any of these things to come to a head. That is certainly an indisputable fact, even where the case is very strong. So if that's the case, what have you been doing and what have you been thinking of make good investments at the moment? We can talk about this in our usual free, uninterrupted way.
Well, there's one area which I think is particularly attractive, energy. And I think, if you're not in energy funds, you should be, conventional energy. And I've focused on the Guinness because Tim Guinness, I think, is an absolute genius. And he's got an extraordinary record in this field, and he's got a very, very good team behind him. And I think that's the go-to place to invest in energy. I think maybe even renewable energy makes sense, not just conventional energy. I think renewable energy is a very attractive place to be, but conventional energy is a sort of contrarian play. One of the things I like about it is the big companies like BP and Shell are now focusing on their core business. They did try and get involved in things that they didn't really know very much about, like renewable energy. And they've sort of decided to go back to their core business. And it reminds me a lot of the tobacco companies. They started to realize that, firstly, that their business wasn't growing. Secondly, that diversification wasn't going very well. And thirdly, that it wasn't going to get any better. So they thought, well, what can we do? Well, we can just make money. We can cut our costs. We can merge, consolidate, and generate cash, buy back our shares, return it to investors. And the result was very good investment returns for a long period of time, even though the fundamentals of the industry were poor. And I think the oil and gas industry faces that. Yeah, there isn't great long-term growth. Oil demand is growing about 1% per annum, and I don't think that's going to accelerate, perhaps a bit more than 1%. It's not going to accelerate, it's going to decelerate. But I think it's a pretty good outlook for companies who don't have to spend an awful lot of money on trying to ramp up production. They can just generate cash. So I think that's a good area. Curiously, actually, I think the UK market is quite a good area because I see a lot of companies really rolling their sleeves up and trying to improve their profitability. And all the lame ducks, which I've been bothered about for the last 20 years, Well, once upon a time, it might even have been AstraZeneca, but it was certainly Glaxo and Vodafone, the oil companies, and Marks and Spencers and Rolls-Royce and British Airways. They all seem to be absolutely determined to try and improve their returns on capital. And stock market isn't taking an awful lot of notice at the moment, but it will do, I think, in time. There's even some positive signs in the banks and those deadbeat insurance companies that we all hate, like Aviva. There are signs that things are getting better in all those businesses. So I think investing in some of these UK specialist funds, sort of like Temple Bar, which is one I've just been writing up, but also a number of in that space, Edinburgh Investment Trust, for example, is a good idea. And all these trusts have been significantly outperforming the index. It's not to say that the UK market won't disappear in time. It might well disappear, but there is good money to be made while it does disappear. And it also creates great opportunities. I mean, another area that's interesting, I think, is mining. For example, Rio Tinto has 2 listings in London and in Sydney. The shares in Sydney trade at a 25% premium to their rating in London. It's a bit of a no-brainer to buy lots of Rio Tinto London shares and persuade the company to emigrate to Australia, I'd have thought. It's the easiest way for Rio Tinto's board to improve value for shareholders is just to emigrate. Why don't they do it? I mean, Rio Tinto doesn't have a single mine in the UK after all. What's it doing here?
Well, it's interesting. A couple of things have come out of what you just said in the last 2 or 3 answers. I mean, one is there is no sort of precise equivalent of Tim Guinness's energy fund in the listed investment trust space. There are 1 or 2. BlackRock Energy and Resources is one, but that's kind of moved its strategy away slightly in other directions. So that doesn't really exist. Well, we do have BlackRock World Mining, on the other hand, and that's been very disappointing over the last couple of years. But you think that might be an opportunity as well?
Yes, I think that looks potentially quite interesting because it's always going to be a volatile industry, but I think the mining companies have learned not to get too excited when demand is hot and the prices are high and not to spend lots of money on expanding production. I think they've learned that lesson. So I think they're now much more focused on finding their way through the cycle, getting good returns on capital and generating returns for shareholders. So I think that is quite an attractive area. It's in the value space, of course, not in the growth space. And they're also beneficiaries, like the oil companies are, of technology. We tend to forget that you don't make money as an oil company or as a mining company from the price of your commodity going up. You make money from extracting it efficiently and cost effectively. And that's the only sustainable returns that you're going to get.
What do you think about the private equity sector and also all those trusts which now invest a significant portion of their capital in private companies of one sort or another? When we spoke last time, you were quite keen on RAT, for example, which has quite significant private exposure these days. And that's also been disappointing. It hasn't really come right yet, has it?
It hasn't come right yet, but you may have to wait a long time. But I think there's probably potential in RIT, but it is a long-term investment. The private equity tends to get a bad press because of people like the Issa brothers and Asda and the highly leveraged takeovers and buyouts, which don't really work. And that's given private equity a bad name. But I think all the listed companies really, I can't find a single one I wouldn't recommend. I think they're all pretty attractive. Even the ones trading at a premium to asset value, like 3i. It's done fabulously well for investors. In some ways, the ones which have got the bit between the teeth, like HG Capital and Literacy Capital, are the most attractive because they've got the wind behind them. But also the other ones, ICG Capital looks very interesting, Pantheon, there's just a huge amount of value out there. And of course, that's a place to invest these days because the authorities and the regulators are so anti-listed companies that it doesn't make sense for companies to list anymore. It makes sense for them to sell out to private equity. So I think if you want to invest in businesses, not just in the UK, but around the world, then you can't just restrict yourself to the public market. You have to look at the private equity funds.
What we have also been seeing a lot of, we've seen the start of a trend of more consolidation. We've seen mergers between trusts. We've seen some bids as well, at least in commercial property, most notably. Have you ever made any money out of trying to spot the next bid target? Is that a strategy you would ever recommend to anybody?
No, I wouldn't recommend it. I just say it's actually can be a long, slow wait for something to go right. And yes, you can make 30% when the company is eventually taken over, but you might be waiting several years in dead money until that actually happens. And it's much better and more profitable to invest in companies which are making steady progress and where there's very little chance of a takeover. I think spotting takeover candidates these days is a bit of a mug's game. It was possible to do in the past. I did do it in the past, but I'd say now it is pretty awkward. But if you, for example, buy a UK small cap trust, inevitably you're going to see a raft of takeovers because the sector is steadily disappearing. And that means that there will be takeovers, not just every year, but every month. So buy a broad spread of companies via a smaller company investment trust, and you will see plenty of takeovers, and probably quite good returns. So I think that's another good area. Small caps haven't done well. They haven't yet recovered. But give them time, I think they will. I recently looked at the comparison of Smithson, Terry Smith's small and mid-cap investment trust, and Edinburgh Worldwide. And on paper, Smithson looks much the better one. But that's probably because it invests in businesses which are already profitable and doing well, whereas Edinburgh Worldwide also is invested in, to some extent, in private equity, but in a lot of companies which aren't currently loss-making. So there could be a fast catch-up, but I think that's an interesting area. Small and mid-cap globally, but particularly in the UK. There was a very interesting piece of research coming out of the US extolling the virtues of buying UK small caps. And I thought, I can't remember when an overseas financial commentator made any recommendations about UK equities at all.
Well, certainly small cap would barely register on the scale, exactly. Can I ask you this question, Max? Fearlessly going where others might not, but a lot of people say investment trusts have got to be 500 million now to be big enough to survive. And one of the biggest recent events that's helped trigger that has been the deal between your old firm and Rathbones, which is sort of consolidation in the wealth management business, if you can put it that way. Do you think that was inevitable, and is it healthy for us in the investment trust sector?
I think it'll prove to be a mistake for Rathbones to absorb Investec. I just think that what's going to happen is that the merger of the two firms will result in a lot of people leaving, spinning off, and starting up or joining boutiques. They'll find the new company too big, too cumbersome, too restrictive, too bureaucratic. We've seen this many times in the past. It's like Standard Life in Aberdeen. It was an absolute disaster. And it was always going to be a disaster. But nobody called it out at the time. I don't think that will work. But I think the idea of a scale investment trusts is not entirely true. There has been a lot of consolidation, but that's not on the basis of scaling up. It's just that when the investment trust industry is under the cosh, quite rightly, boards look and see, do we have a purpose to our vehicle? We're trading on a large discount. We're not going to be issuing shares. We're not particularly economic. We haven't got a great record. What can we do about it? So we've seen some mergers, and out of these mergers, we'll get some strong funds. Interestingly, Henderson's Euro Trust is merging with ffolkes. And I never really understood why they had two funds doing more or less the same thing run by different managers, or which was the better. And it does make obvious sense to put the two together, and they've done that. Aberdeen has done extremely well in terms of filling out its long list of smaller investment trusts, and they're to be commended for that. And actually, this is spreading throughout the industry. I think it's a great positive. But I don't think scale is a big story. What the wealth managers forget is there's a very large and growing body of direct or platform investors who don't really care about scale. They just care about finding good, well-managed trusts at reasonable prices. So there is somewhere in the market for a £100 million trust, just as there is for a £1 billion trust. I'm not sure £50 million really cuts the mustard, frankly, but £100 million trust, I think, is got a perfectly decent future.
And at some stage, of course, if the investment trust sector is going to survive and recover from this current cyclical downturn, if you like, we've got to get some new trusts, and it's not easy to launch them at the moment. But certainly if people are saying they've got to be really big before you even start, that's not particularly helpful, is it?
Well, no, but one of the concerns I do have about the investment trust sector is that I worry that the culture of star managers is disappearing. Professional fund management companies don't like star managers because they have to pay them lots of money. They can be temperamental. They're not team players. They can up sticks and leave. And yet, actually, that's what the private investor wants. They want a star manager, somebody who tells a good story, has performed well, and whom they can have faith in. And I think that steadily we're seeing the star managers retiring or leaving and being replaced by this idea of investments by committee. And that's not going to be appealing to the private investor. So I think we need to have more eccentrics. The Terry Smiths, certainly, the Bill Ackmans, they're the people, or those that Bailey Gifford, people who've got something to say, that's what they want. They don't want institutional fund managers where it's all part of a team process and, oh yes, we tick the boxes on compliance and ESG and all that sort of stuff.
Or maybe what they'll get is eventually is a robot rather than a star fund manager, or even a committee. They'll get some kind of robot-driven process, which may or may not be good. We'll have to find out.
It has been a bit of a chase into what they call quality investment. And this means companies which have got high barriers to entry, oligopolies, they've got long-term growth, good margins, low gearing, cash generative, etc., etc., etc. That's the sort of standard favourite of all the professional fund managers. And it's become a bit of an overcrowded trade. And sometimes you need people who look at the stocks which are spurned by the institutional managers, like at the start of last year, Marks and Spencers and Rolls-Royce, which were fantastic performers. The institutional mindset is not one which takes very much risk. That's not where the returns are.
Indeed, it's not. I want to end, though, Max, on a more contentious issue, perhaps, and this is one which you wrote about recently in one of your Money Week articles, and I'm sure will be of interest to many of our listeners, which is this idea that we should effectively get rid of all the golf courses in London and replace them with housing. That's the way to solve the housing market problem we have in this country. So justify that one for me.
It was a bit tongue-in-cheek. The idea occurred to me when I was having lunch with David Starkey underneath Hans Holbein's Henry VIII and the Court of Barber Surgeons. And I suggested to David whether dissolution of the golf courses wasn't a good idea, something he could approve of. And I said, well, they seem to occupy an awful lot of space in London, and we could build houses on them or use them for recreation purposes and take a leaf out of Henry VIII's book. You could see where I was coming from, but for ideological reasons, he couldn't possibly agree with me. But anyhow, once I started looking into it, like a lot of weird ideas, it sort of makes an awful lot of sense. A very large part of London is occupied by golf courses, the size of a large borough of Brent. There's more land occupied by golf courses in Surrey than there is by housing. And it seems to me that there's far too much space in a crowded country like England that's taken up by golf courses, and there isn't enough space for recreational use or for housing. And golf courses are the obvious place to start. And there are some wonderful places to play golf, like, for example, St Andrews or the Suffolk coast. Not London. We have 5 or 6 golf courses within a mile or two of here, so I can't see how you can possibly justify all that land being used to so little benefit to the public interest.
Well, it's certainly the case. If you go to one of the less well-known golf courses around London, which there are a lot, I think you said there are more like 70 or something, 75, during the week, there is not a lot of occupancy going on there. And it's a lot of ground that they cover. Of course, you're absolutely right.
The UK has a disproportionate share of Europe's golf courses, and it seems to have an awful lot of golf courses for a relatively small number of people.
So there we are. I'll throw that one out for our listeners to comment on. A bit of consolidation in the golf course business. A lot of them are owned by local authorities, of course, who are the ones who are always complaining they haven't got enough space to put up houses.
No, so local authorities and by public institutions. Yeah, absolutely right. About half of them, in fact. We have no objection to the game of golf, but played in the proper place. And that is not in places like London, where land is hugely valuable and in short supply for housing.
Well, on that note, thank you, Max, very much for offering us your thoughts. Always interesting and always, I hope, will stimulate some interest from our listeners. And in the meantime, you remain, as you said, optimistic in the medium term and perhaps a little bit not sure about the short term.
I'm not expecting much for the time being, but I'm just expecting, occasional pops here and there from good companies with good results and for the market to potter along and for the earnings growth to come through and turn the market back to reasonable value again. There's always a possibility of a setback to the market. But, a setback of the market of 5 to 10% wouldn't be tradable for most people. So I just think, you just keep going, and there's a long way to go for in these markets over the next few years.
So that was Max King, former fund manager at Investec and elsewhere, and now a regular columnist in Money Week and other places.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.